everybody. So welcome to the spring 2019 meeting of the Shadow Market Committee. We have a very busy schedule today. We're going to start right off with the panel. Before we start the discussion, I'd like to briefly mention the event is hosted by the Manhattan Institute, and the Shadow Market Committee is very thankful for the support from the Manhattan Institute for this event. After the two panels we have, we will have a keynote address by Vice Chair Randal Quarles. This is going to be at noon. And the drawback of moving a little bit earlier is that I hope you have gotten your caffeine already, because we have not scheduled for additional coffee breaks.
Well, good morning, everybody, and welcome to our spring meeting, as Athanasios said. I guess this is my first active meeting returning to the Shadow after having been on this organization for something like 15, 20 years, or somewhere 15 years anyway. Kind of took a break and went to the Fed, of course, and now I'm back. So I'm delighted to be back and see everybody here. So today I'm going to spend a little time talking about the balance sheet, and mostly about operating regimes and the relationship between those two things, and some of the things that I think remain unresolved questions, risks of that, and try to clarify that. Some people like to talk about normalization. That's okay. I'm not sure quite what that means, and whatever you think it means, and regardless of when you think normalization occurs, the discussion about how it ought to look is important no matter what. After all, I've been talking about it since about 2009, when I first started talking about where do we go when this unusual period is over. And I even gave a paper here, a talk here, keynote address entitled Exit. That was the title of the talk. That was 2011. So I'm being very patient here and repeating myself about what I think the important themes of normalization might be. And that exit paper, I talked about four things. I talked about the Fed needed to have an inflation target. By the way, 2012, we got that. Check one. It needed to conduct policy more systematically. I'm not sure we're there yet. We've been trying for that for a couple of decades now and haven't quite gotten there. I also emphasized that I thought it was going to be important that the Fed specify its end game from unconventional policy, and there I thought the Fed ought to be returning to a corridor system and targeting the federal funds rate much as it did before, and I'll talk a lot about why I think that today. We haven't gotten there yet. In fact, we may be going in the wrong direction. And then I talked about an all treasuries portfolio for the Fed. Fortunately, I'm very pleased that in this last round of announcements by the Fed, they actually seem to be moving towards an all treasuries portfolio, at least an argument, because they talked about their options when they reduced the size of the balance sheet, or even if they kept it the same, as MBS rolled off, they were going to replace those by treasuries. So as a move to try to get to less credit allocation and more all treasuries type portfolio. So I was very pleased to see that. So that may take a while. At least I feel good about that part. So 2 out of 4 so far is not a bad batting average, but we've still got a ways to go. So in my talk today, I'm going to talk about 2 or 3 types of things. One, I'm going to talk a little bit about institutions and the role institutions play in the making of policy. Was a hardcore academic for many, many years, and then I spent almost 10 years at the Fed as a policymaker. And now, I'm a little more sensitive to sort of the role institutions play. I'll talk about that. And then I'm going to talk a little about operating regimes and the Fed's balance sheet and how they're interrelated. And there I'm mostly going to talk about stylized corridor systems and floor systems. Then the third thing I'm going to do is talk a little bit about questions and concerns I have about an operating regime, which is in particular the floor system, operating regime with a big balance sheet. And by a big balance sheet, I don't necessarily mean just big in size, because that varies over time for lots of reasons. What I'm really talking about is a system of large volumes of excess reserves in the system. And I'm going to talk some about what I feel about issues that the Fed has not chosen to answer yet or haven't addressed, about operational issues. I'm going to talk about some governance issues that I think are important in that regime. And I'm going to talk about some economic and political risks that surround that. So let me start with a little bit about institutions. Policymakers operate in an institutional framework, and that influences both the incentives of the actors making policy. It affects their incentives, and of course that in turn shapes their choices of policies and outcomes. Now, of course, you operate in a policy regime, and so understanding how to recommend and make good policy often requires understanding and appreciating the fact that that institutional environment makes a difference. Now, of course, the institutional environment is not fixed. It's not etched in stone. Institutions change, and oftentimes policymakers make decisions, make policies. Those policies are reacted to by other institutions, and oftentimes that leads to a clash, in which case institutions naturally evolve. And not always for the best, but nonetheless they do evolve. The other part is related to that is that political independence for the Fed, in monetary policy in particular, independence is an important pillar of sound central banking and monetary policy. Institutional arrangements, operating regimes, they can either act to reinforce that independence and support it, or in fact they can act to undermine it. And we need to be cognizant of those tensions and those things as we make our policy choices. The last point about institutions I'll make, and I'll be making some more as we go along, is that in a democracy, political independence for the central bank must be accompanied by constraints. Because without those constraints, you can't have independence and you can't have accountability. And so I think it's really important that we think about our policy choices, our frameworks, our institutions in ways that support independence rather than ways that possibly undermine independence. And I'll be coming back to that point as well. So let me talk briefly about the two choices of operating regimes that we hear a lot about. Most of you probably know this. I'm just going to make sure we're all on the same page. I'm going to talk about two stylized regimes for operating monetary policy. And the key difference between these stylized regimes, and what I'll focus on, is that, the two regimes are a corridor system, and the Fed, prior to the crisis, operated under what looked like a corridor system for many, many years. Okay. A corridor system is a system where the Fed set a target for the federal funds rate, the rate that banks trade between each other, and they set a lower bound by what they were willing to pay on reserves. And of course, in the old days, they paid zero, so the interest rate was zero on reserves. And they had an upper bound, which is sort of the primary credit rate, for which the federal funds would never go above, or rarely would ever go above, simply because the banks could borrow from the Fed at that rate, and so there was no need to pay more. And that's a kind of classic corridor system. And the target was set in between the upper bound and the lower bound. More popular recently has been what they call a floor system. And there, the lower bound is the interest paid on reserves, in particular excess reserves is important. And the target rate is the interest on excess reserves, in effect. So you're always at that pegged administrative rate called the interest rate paid on reserves. Now, the key difference between those two is that in the corridor system, the balance sheet matters. The balance sheet has to be small enough to boost the funds. Reserves have to be scarce enough so the funds rate target is above the interest rate paid on reserves. That's what makes a corridor system a corridor system. And a balance sheet, so there, the balance sheet, the size of the balance sheet matters. And it matters for the conduct of monetary policy. Under a floor system, the balance sheet doesn't matter anymore for monetary policy because the floor system pegs the interest rate. The instrument is the interest rate paid on reserves. That's the floor. If you want to raise rates, you just raise the floor, raise the interest rate on reserves, and if you lower it, you want to lower the interest rate paid on reserves. And the balance sheet doesn't matter. As long as the balance sheet's big enough to satiate the demand for reserves, the balance sheet can be as big as you want it to be. So the balance sheet doesn't matter necessarily for monetary policy anymore. That's my concern. So now a Carter system is a system for operating monetary policy regime, if you will, that has been practiced all over the world in different countries at different times. And it functions pretty reasonably, and reasonably in the sense that the targeted interest rate on the federal funds rate was transmitted to other short-term rates pretty broadly. Yeah, people point out there was volatility in the federal funds rate, and that's okay, but that volatility was mostly daily volatility or weekly volatility. Sometimes was driven by reserve requirements having a maintenance period, so at the end of the maintenance period you got volatility in the funds rate as people tried to sell up their accounts and meet their reserve requirements. But it was mostly at a daily level, not at a longer term or medium term level, which is the concern of monetary policy. It didn't seem to affect the implementation of monetary policy objectives. And so that was the way the world generally worked. Now, under the floor system, of course, reserves are not crucial, as I was already saying, and the instrument on monetary policy, the key instrument for implementing monetary policy becomes the interest rate on reserves. And so that's an administered rate. That's a rate just set by, in particular, the Board of Governors of the Federal Reserve System. And it's not a market rate. It's just a declared rate is what the Fed's willing to pay. Now, what we all know, of course, is that since the financial crisis, we've had QE blown up a volume of reserves. A volume of reserves in 2006 was like $85 billion, something like that. In 2014, the volume of reserve was 2.8 trillion. Required reserves were only about 100 billion at that point. So you had $2.7 trillion of excess reserves just floating around in the banking system. And now that's shrunk some, where there's now about 1.6 trillion excess reserves, total reserves, and about 1.5 trillion of excess reserves. So right now, the Fed really has no choice but to operate on something that looks like a floor system. So there are four things I want to question about the floor system. And by the way, the Fed seems to be inexorably moving towards its preferred system, which seems to be a floor system of some kind going forward. So I have 4 questions. I think the operational benefits, well, let me back up just. Remember, we got to this through QE. We flooded the market with reserves. We flooded the market with reserves. The federal funds market became mostly moribund because the banks were so flooded with reserves there was no really much need for trading them, and there's some details about that we might want to talk about. So I want to talk about what the Fed says are the benefits of this floor system that they want to continue. I'll talk about the dubious nature of those. I'm going to talk about the role of the balance sheet in conducting monetary policy, some of the governance issues, and the political economy issues. The Fed has emphasized during the crisis that QE was important for monetary policy. QE1 was kind of flooding the banking system during a crisis, which is fine. That's kind of a different issue for the moment. But QE2 and 3 were monetary policy objectives that declared we're at the zero bound, we need to do this to provide more accommodation in a monetary policy sense. Now the Fed's busy trying to rationalize, well, we want to keep this regime. We want to keep a lot of excess reserves on the balance sheet. And, okay, their argument for doing that has nothing to do with monetary policy. Their argument for doing that seems to be, well, it's simple. It's worked. It'll help us control short-term rates. Okay? And the other argument is improvements in financial stability. And, by the way, meeting a regulatory requirement, which is the LCR, liquidity coverage ratios. So now there's a regulation that banks have to hold this extra liquid material, of which reserves is one very liquid asset. And I'll talk about that. So the Fed argues that this floor system is working, it's efficient, and it's simple. Well, it's not that simple. And it's getting more complicated all the time. The floor system is being currently implemented requires that the FOMC set a target for the federal funds rate. It's not a target, it's a range, 25 basis point range. That's different. That's set by the FOMC. The floor system then requires that the Board of Governors, who determines the interest on reserves, not the FOMC, set a interest on reserves number. So there are two different bodies, the Board of Governors and the FOMC. They both have to make separate decisions. And now we understand two more things. One is that the Fed had to create this reverse repo operation because there were so many reserves in the system, they had to soak them up at times in order to maintain a lower bound on the Fed funds target range. Because there were so many reserves, the Fed funds rate was not getting even above or close to the interest on reserves. So they've had to implement this new program called RRPs, and now, just recently, there have been proposals for a company to set up a narrow bank, which basically takes deposits and turns them into reserves for a slight fee. Now the Fed has decided they don't like that, so they're now creating a regulation where they're not going to pay that bank or banks with that business model the same interest rate on reserves as others. There's a regulation that's having to be created in order to make this system work. Well, of course, this system has also been driven in part by a regulation called liquidity coverage ratios. And, so this is not a simple system. And it's likely to have unintended consequences that will get us more complicated. So this other argument about the Fed, the large reserves are paying a buffer of highly liquid assets, is good for the banking system. That's good to have this buffer, provides liquidity and support. I don't know if there's really any evidence for that. It sounds good, but is there really evidence for that? Fed hasn't really offered any, and it would be interesting if they could or would. Does this make the balance sheet now a tool of financial stability instead of a tool for monetary policy? It's an interesting question. Is that a good thing or a bad thing? I think there's some questions about that. Is it wise? And so what are the consequences of that for the transmission of monetary policy? The Fed really hasn't addressed that either. So why does the Fed going into the marketplace, buying treasury bills and exchanging them for bank reserves? Treasury bills are a pretty liquid asset. By the way, they meet the liquidity coverage ratio if banks hold them. So why does that swap increase liquidity or increase stability? I haven't really made that case as far as I'm concerned. In fact, what you might think about them doing in that case is taking one highly liquid asset out there, and we call them treasury bills for the moment, which are highly liquid, can be used as collateral for lots of institutions, and liquidity for lots of institutions. And they're taking that out of the market and giving the banks treasury reserves. So you're taking a bunch of liquidity that might be in the hands of the broader financial system and confining that liquidity to banks. Is that a good thing? Does that help? How does that help the financial system? They really haven't explained that to us. The only way it might or could shape is if you don't buy risky assets. You don't buy risk-free assets like treasury bills. You buy risky assets. Well, maybe that improves liquidity, but it also carries risk. There's no such thing as a free lunch here. It carries risk because then the risk that the Fed takes on, either duration risk, for example, longer-term assets that it buys, or private assets that are risky, that risk gets fostered off, doesn't go away, it just gets fostered off to the taxpayer. So I don't know. I don't really understand, or I find this argument about increasing liquidity very, very appealing. And in fact, it may do exactly the opposite. The other thing they say that it reduces volatility of the funds rate of the instrument. In this case, well, IOER is not very volatile. It's just set at a number. But the argument that the Fed funds rate was too volatile and that was undesirable, I don't find that very credible either. The Fed funds rate, as I mentioned earlier, was volatile mostly within the day. But that really didn't matter for monetary policy. As long as the funds rate target got transferred and transmitted into other short-term rates, which it did, that intraday volatility was not terribly important. And I don't know why you feel like you have to squash that. So I just don't buy that argument as terribly compelling, at least not at this point. And on top of all that, in order to do this, since the floor system is kind of leaky right now for lots of other reasons, doesn't work, they now have had to engage in counterparties in the marketplace that they never had to engage in with before. The RRP program now is available to some 150 institutions that didn't have access to reserves before. And so now the Fed has a bigger footprint. It's interfering in short-term money markets. What are going to be the long-term consequences of the shape of the money market going forward? The other point I want to make, and I'll be through in a minute, is the governance issues. Federal Reserve Act says that monetary policy is the responsibility of the FOMC. There are lots of reasons for that. It has to do with the presidents and the decentralized systems and political issues. But now, on our floor system, it is the interest on reserves that's the really operative monetary policy decision. That's a decision made by the Board of Governors, and the Board of Governors only. It is not constrained by actions of the FOMC. So now you have a governance question. Who's controlling monetary policy, and how does it behave? Could a Board of Governors at some point decide that they don't want to do what the FOMC thinks? They're going to set the interest rate on reserves at whatever they want? Well, technically, will they do that? I don't know. They're kind of operating collectively now, but in this new day and age where we have lots of political risks with the Board of Governors that may not exist with the President, they may choose to go a different way. So there's a governance issue that needs to be resolved here no matter what. Who gets to decide on how many excess reserves are out there? How big the balance sheet's going to be? Is it the FOMC? Is it the Board of Governors? How are they going to decide how big the balance sheet will be? How are they going to decide, and who will decide how many excess reserves are, quote, needed? I think as an economist, I always learned at Chicago that need is a little slippery word. Depends on whose needs you're talking about. So I think we have to be careful. And finally, it's the political economy issues going on here as well. The monetary policy regime in the floor system means the balance sheet can be anything anybody wants, even if it's all treasury bills. Who gets to decide, and how will it be used? If that balance sheet is a free parameter, I guarantee you that there'll be lots of people who want to use that and abuse that balance sheet for lots of other purposes. In fact, there's a history of this just in the last 10 years. In Dodd-Frank, the Fed was required to pay for the Consumer Finance Protection Agency. Now, did that make any difference to the taxpayers? No, because just the Fed turned over less money to the Treasury at the end of the year. But it meant Congress used the Fed as an off-budget fiscal tool because the Consumer Finance Protection Agency no longer had an appropriations part to it. Funds weren't appropriated. They were said their expenses are, I forget what the number is, 10%, 12%, some number of the Fed's expenses. Done. No review of that budget, just a fixed number, off-budget fiscal policy. In 2015, Congress took money from the Fed's balance sheet in the form of surplus, just sort of took it away from them and used it to finance the transportation bill to the tune of about, I don't know, I think it was $25 billion or $30 billion or something like that. So they just took it off the Fed's balance sheet. So I think politically and independence-wise, we need to be really careful about creating a new free parameter, that is the size of the balance sheet, to be used for other purposes, whether it be off-budget fiscal policy or what. Congress is very keen these days on new spending, whether it be for defense, infrastructure, new green deals, you pick your favorite cause, and they're now talking about the Fed paying its fair share. You laugh. I sat in a congressional hearing where I was testifying and I got exactly that question. We need new spending on infrastructure and other things, and the Fed should, I quote, pay its fair share. So there are lots of incentives for the administration and Congress to look to the Fed to avoid taxations, explicit taxations in the near term. This is very dangerous. Whether it be bailouts, imagine Illinois and California go bankrupt, state governments. All of a sudden the Congress decides, well, tell the Fed you need to go buy some of the municipal debt to support them. After all, that's what the ECB did for Greece. It's kind of a similar analogy. You know, how is the Fed going to say no? It doesn't affect monetary policy, by the way, because that's decided over here on the floor system with interest on reserves. How do they say no to that? Or maybe they don't. So, and my final point about the politics is the Fed's doing itself a disservice in two ways here. One is, since the crisis, the demand, remember I said at the beginning that the Fed, to preserve its independence, protect its independence, it needs tools, but it also needs constraints. So the conflagration of monetary policy and financial stability, this is leading to the Fed to expand its scope of operations, its breadth of decisions, its breadth of interventions, all in the name of financial stability perhaps, maybe in the name of regulation, maybe in the name of monetary policy. That is opening the door for Fed to demand and want more flexibility, more tools. So it is removing constraints on the Fed, not increasing them. And as you remove those constraints on the Fed, you open the door to failure of independence. Because now the politicians are going to have more things they want done, more scope for actions, more scope for responses. And the Fed is aiding and abetting that unnecessarily, I think. And they're putting at risk their own independence by their choices, as well as the pressure on independence from Congress and the administration, perhaps. So I think this is a very dangerous mix of things going on. It's dangerous. I talked about way back in 2009 when we embarked on this unconventional policy, and they're even more dangerous now than they were then. So I think the case for a floor system that the Fed is arguing is not well substantiated, not terribly convincing. They haven't told us about how it interacts with monetary policy. Monetary policy was supposed to be about QE, all right, but they haven't told us how a big balance sheet under this floor system with lots of excess reserves, how does that affect their conduct of monetary policy? Does that mean the big balance sheet doesn't matter for monetary policy anymore? They've explained nothing about the relationship between the floor system and the conduct of monetary policy that is at all coherent with what they said going into the recession and creating the big balance sheet in the first place. So what is the relationship between monetary policy? What is the case for financial stability? What's its case for its operating simplicity that they claim? None of these arguments to me are very compelling at this point, and the risk of unintended consequences and the loss of independence can be quite large. So I think we need to proceed with serious caution. So I've talked way too long, but thank you for your patience.
Thank you, Charlie, and we're going to go directly to Peter's presentation and then collect questions after after hearing Peter's views of the balance sheet. While we're fixing the microphones, I'm going to say that we're not going to discuss the euro area here today. I'm free to do that later on. But it's not the case that the ECB purchasing member state debt in the euro area is equivalent to purchasing municipal debt in the United States. It's actually closer to the Fed doing QE, which the Fed is doing, because that is the government debt in the euro area. That's a different discussion.
See, we don't always agree on things, that's all right.
All right. Immediately following their January 2019 meeting, the Federal Open Market Committee released a new statement on monetary policy implementation and the balance sheet, which worked to clarify 2 points of committee consensus and their implications for monetary policy making going forward. The statement indicated first that the Fed intends to continue targeting the federal funds rate using the floor system that Charlie just described. As he explained, under that floor system, the Fed manipulates the interest rate that it pays on reserves in order to bring about similar changes in the federal funds rate, while operating with a balance sheet that's considerably larger than it was before the financial crisis. The statement indicated, second, that during normal times, the FOMC expects to continue implementing monetary policy via federal funds rate targeting. If or when the funds rate again approaches a range near zero, though, the committee may bring back quantitative easing to deliver additional stimulus at the zero lower bound. Now, at first glance, at least, both of those points seem sensible enough. I agree wholeheartedly with Charlie that the floor system unnecessarily exposes the Fed to a myriad of economic and political risks and ought to be abandoned in the long run. For now, though, the floor system does seem to be working, mechanically at least, to allow the Fed to renormalize its interest rate policies and hold inflation near but still below the long-run 2% target. In addition, even though the U.S. economy continues to expand with no immediate recession in sight, certainly it's prudent, absolutely, for committee members to be thinking now about contingency plans for the next cyclical downturn, when the zero lower bound may again constrain traditional federal funds rate targeting. Now, having said all of that, if we take a step back and ask about the analytic framework that underlies the FOMC statement on implementation, then we can begin to see not so much errors or flaws, more what I would call elements of incompleteness or omission, that if more fully recognized would help to make Federal Reserve policy more effective and more robust. In particular, when you take a step back and look at the statement as a whole, you begin to realize that running throughout it all is the highly Keynesian view that monetary policy actions affect the economy only to the extent that they impact on interest rates first. So during normal times, the FOMC focuses on the federal funds rate and other short-term rates. At the zero lower bound, they switch to quantitative easing, but mainly as a tool for influencing longer-term interest rates more directly. This was part of what I think Charlie was getting at the end. For the FOMC, it would seem monetary policy is interest rate policy, and within this framework, balance sheet policy often seems like something completely different, a separate set of tools used to influence credit market conditions instead. Now, monetarist economists like Milton Friedman and Anna Schwartz and Carl Brunner and Alan Meltzer were often critical of the Keynesian view of the monetary transmission mechanism for exactly this exclusive emphasis on interest rates. They argued that additional and valuable information about the stance of monetary policy could be gleaned by looking at measures of the money supply, the monetary base, and the broader monetary aggregates as well. And we can critique the FOMC's statement on implementation from a similar angle by pointing out that all monetary policy actions undertaken to influence the aggregate nominal price level, even those taken to target the federal funds rate under a floor system, must, sooner or later, be supported by open market operations that change the supply of base money and therefore have implications for the size and composition of the Fed's balance sheet. So the division between monetary policy on the one hand and balance sheet policy on the other is not nearly as clear-cut as the FOMC's statement would have us believe. Now, to see why this has to be true, consider the following example. Suppose that we begin in a long-run equilibrium in the market for reserves, where the Fed is happy with the dollar volume of reserves that it's supplying to the banking system, and banks in turn are happy to hold or demand the same dollar volume of reserves supplied. And now let's imagine that beginning from that initial equilibrium point, nominal GDP continues to grow at an average annual rate of, let's say, 5% per year. Looking 5 years out from the initial equilibrium point, 5% growth per year in nominal GDP is going to translate, after allowing for compounding, into an increase in the level of nominal GDP of more than 25%. So we can begin to see with this thought experiment how, if the Fed conducts monetary policy targeting the funds rate with a floor system over this 5-year period, but really never conducts an open market operation ever again, the initial equilibrium is going to be severely disturbed, because by the end, banks are being asked to hold the same dollar volume of reserves, but the nominal size of the American economy is more than 25% larger. Now, FOMC members would probably try to describe this chain of events as it unfolds in real time by saying something like this. They'd say, look it, like we said in our statement, the implementation strategy is targeting the funds rate using the floor system. And those open market operations that you're talking about, yes, they do have to occur, but those are just technical details. Of course, we must conduct open market operations to slowly expand the supply of base money because we need to accommodate the increase in the demand for currency and bank reserves that takes place due to the slow but steady growth of the American economy as a whole. A monetarist would say, though, the problem with the way that story is being told is that it risks confusing cause and effect. Because for a monetarist, the whole reason why nominal GDP would be growing at a 5% annual rate in the first place is that everybody understands that monetary policy is being conducted in a way that generates similar long-run growth in the supply of base money. So a monetarist would say, actually, the implementation strategy is conducting open market operations to give rise to slow but steady growth in the stock of base money in order to stabilize the growth rate of nominal GDP and, by extension, the aggregate nominal price level. And this was what Charlie was getting at a little bit too. From a monetarist perspective, the floor system really is just a set of technical details intended mainly, to be honest, just to smooth out what would otherwise be high-frequency fluctuations in money market rates. That is, to engage for better or for worse in interest rate smoothing. Now, why, last question, why is this distinction important? The distinction is important because from a monetarist perspective, there is no necessary disconnect or discontinuity between monetary policy making at versus away from the zero lower bound. During normal times, the Fed targets the federal funds rate but must support whatever procedures it's using to target the funds rate with open market operations designed to control the supply of base money and stabilize the aggregate nominal price level. At the zero lower bound, the Fed switches to QE, which on the surface seems quite different, but should have exactly the same economic function and purpose, namely exercising control over the stock of base money to stabilize nominal income and spending in the face of whatever shocks have sent the economy into a severe recession, causing interest rates to fall to the zero lower bound in the first place. So the implication is that there's no reason from a monetarist perspective why the Federal Reserve cannot conduct monetary policy in a more seamless, consistent, rule-like manner, both at and away from the zero lower bound. And there are at least two different ways that it might go about doing so. The first was actually suggested at our meeting last year by Athanasios and Greg Hess. They suggested that the FOMC begin by announcing an explicit interest rate rule to guide the setting of its federal funds rate target during normal times, but then to augment that initial announcement with a separate announcement articulating just as explicitly a contingency plan for conducting QE at the zero lower bound. So that approach would allow the Fed to retain much of its existing implementation framework, but it would fortify it by bringing into the picture the monetarist proposition that monetary policy works best when it is conducted according to simple pre-announced rules. That would be one approach. Based on the example I just gave you, however, and the analysis that preceded it, I would prefer something a little bit different. If I were advising the FOMC today, my advice would be let go of the hardcore Keynesianism and at least begin to describe your monetary policy actions in terms of their implications for these things. Growth in the monetary base, the broader monetary aggregates, nominal GDP, and from there to the aggregate nominal price level. Doing that would de-emphasize the zero lower bound as an obstacle to effective monetary policy making and would allow the Fed to conduct monetary policy more effectively both at and away from the zero lower bound. It would allow the Federal Open Market Committee to pursue its stabilization objectives in both good times and in bad. Thanks.
Thank you, Peter. Now, both of you made us worry quite a bit, and it's time to take a few questions about your presentations. But I'm going to actually start by asking both of you one very specific question. Following up with your presentations, I also think, like Charlie said, that the Fed deserves praise for announcing pretty much that they're going to move to an all treasuries balance sheet. This is what we have been arguing for some time for this, and it's a very good thing. What they have not done, and this is reading from the implementation note they announced last week, is what the endpoint is. And this is part of where are we headed. This is part of implicitly, both of you asked this question, where should we expect the Federal Reserve balance sheet size to be 5 years from now? And the way Peter put it, in relation to nominal GDP, really, that's the endpoint. The equilibrium has to be determined and discussed as how large is the Fed's balance sheet relative to the size of the economy. The Fed has said nothing about that, and this is really the main concern that I identify in Charlie's. What do you guys think the answer should be? How should the Fed go about determining and providing that number? We know what that number was before the crisis, but right now they may end up at a different place. How do we think about that? What advice would you give the committee?
Well, I think that the Fed legitimately faces some hard questions about this that they, in fact, don't know the answer to. So they can't give you an answer, which is unfortunate. I mean, there are regimes and ways to do this, but as I mentioned, I don't know what the underlying demand for reserves is going to be, and neither do they. The reason the corridor system worked is because the Fed responded to the demand for reserves, the fluctuations in a market interest rate called the Fed funds rate, responded to that and would, in the short term, supply or repo operations to expand the balance sheet a little bit or reduce it a little bit in order to keep the funds rate kind of in this range. Now, of course, interest on reserves is not a market interest rate, so the Fed's not getting any feedback particularly. So I think the question, and then the second part of that is that the other thing is happening to the demand for reserves is the unknown effect of the variability in regulatory rules. The liquidity ratio has changed, and they've admitted this, and they agree, I agree. It's changed the demand for reserves. We don't know really how. I mean, we have to remember that some people say, well, it's evident that the banks really want a lot of reserves because they're holding so many of them. That's nonsense. Banks hold reserves because they have to. They don't have any choice. The only part of the economy that can hold federal reserves at the Fed are banks. They can't get rid of them. They can move them around with each other. Some of them go to foreign banks, some of them go to domestic banks. I mean, they can move them around, but they can't get rid of them. So the quantity of reserves being held by banks today is completely uninformative to the question of what's their true demand for reserves under this liquidity ratio. And since the liquidity ratio was driven by, Charlie Calamirez, correct me, by Basel international financial stability issues, as that changes, the demand for reserves is going to change. So you've got a regulatory function here that could possibly cause fluctuations in that demand for reserves, which now the Fed's going to have to respond to in one form or another. So I think they don't know where they're going to end up. The advantage of a Carter system is that you reduce reserves until the point where they're scarce. And the interest paid by banks in the federal funds market will tell you something about that. So if you target that slightly above interest rate on reserves, you actually can find where the right equilibrium should be. So there are ways to do it, but they don't want to do that because they want this floor system, which makes it difficult to actually implement that. I mean, they could get there, but they don't seem to be quite. So I think they've got a hard problem here, but it's a problem they're creating for themselves, not one that's inherently an inherent problem in some sense in the system. I don't know if you can elaborate on that.
Right. I think the question is a good one because it highlights yet another advantage of looking at things from this monetarist perspective. If you look at the FOMC statement on implementation and listen to other statements given by the FOMC and individual committee members, you get the idea that the biggest challenge facing monetary policymakers today is figuring out how to deal with the zero lower bound, how to deliver monetary stimulus once interest rates approach zero. Monetarist theory would tell you the way that you do that is to try and generate growth in the money supply at the zero lower bound. Paying interest on reserves, the problem is it shifts the demand curve for reserves to the right instead. So that by itself sends a deflationary impulse through the economy, exactly the opposite of what you want. So I join Charlie in suggesting that the floor system be abandoned or returned to a corridor system, but partly because I think it would help the Fed deal with the problem of the zero lower bound by snapping the demand for curve for reserves back to where it used to be. But to answer the question more directly and building on what Charlie just said, it may be true that because of regulatory issues or because of concerns over financial stability, the Fed finds it optimal for non-monetary policy reasons to operate with a bigger balance sheet with more reserves supplied to the banking system than it did relative to what happened before the financial crisis. My answer then would be figure out what the steady state level would be based on those financial considerations, and then conduct quantitative easing in the same rule-like manner that you and Greg suggested last year, with reference to generating enough monetary stimulus to stabilize nominal spending in the face of whatever shock is hitting the economy, causing the zero interest rate constraint to bind.
Let me just throw out another idea. I'm not necessarily advocating this.
And I'm going to move here so that I can take more questions.
Not necessarily advocating this, but you think about what's going on. Liquidity coverage ratio and other regulatory stuff about financial stability is about trying to build a more stable, less runnable, more capital-intensive banking system to protect financial stability. And of course, Basel and regulators have tried to increase capital, which is not, I actually think that's a very good idea. But now, by using the balance sheet to try to make arguments for financial stability and therefore, in my view, confusing what role monetary policy is playing here and conflating these two in a confusing way, One of the things you can do is you're just gonna say, all right, what we're gonna do, we're gonna use regulation, but we're now gonna change the reserve requirements from 4% to 20%. And we're gonna force you to hold 20% reserves on your deposits. And by the way, if you do, as a bank with a depository institution, we're gonna relax some other capital constraints, for liquidity and other things. And you can support financial stability in that way. That actually might be a simpler way to go about this rather than creating all these sort of moving parts. Not necessarily advocating that, but trying to think about the problem you're trying to solve more directly in a more straightforward manner. If you did that, you could then take a big step to reaching what Peter's saying is disentangling these two pieces, monetary policy and financial stability, from each other and creating fewer of these confusions and problems and potential instabilities and variability. Just a thought. I'm not advocating that, but it's a way to think about what alternatives might be to achieve the same outcomes.
Anne-Marie?
First, I'd like to thank Charlie especially. That speech needs to be given to economists everywhere. Because I was at Money Marketeers meeting a couple of nights ago, and it was clear from the questions that the Fed's shrinking of the balance sheet was thought of by some people in the room as a major tightening because it was reducing base money, whereas other people thought it was an operational triviality because as long as the demand for excess reserves is being set by something other than a wish to get rid of them because they're costly to hold, which isn't the case when you're paying interest on them, that it doesn't matter from a monetary point of view. And this is a group of sophisticated financial participants who couldn't get their hands around that. And I think part of the problem is if you go back to the history of advocating for interest on reserves, it was always to be on required reserves only. And if they could get their heads around that concept, then your suggestion of 20% required reserves could work because there wouldn't be a big tax on the banking system as they were in the period when no interest was paid. And the holding of excess reserves would then become something that banks would economize on. They would hold them because they needed them, because they needed them to avoid overdrafts, which was the primary motive of holding excess reserves in the old system. So I think, and that also comes back to base money. The concept of base money was it was the stuff that the banks had to hold, not the stuff that they were voluntarily holding because they wanted to be treated to it. Anyway, that's partly a speech, but partly
No, I would sort of say, one of the things I was trying to get at is this issue is the Fed has been incoherent between QE and now about what balance sheet effects are. We went into this praising the growth of the balance sheet, its effects on promoting accommodation. Big is a good thing. It was bringing down long-term rates, or however you want to describe it. They described it in lots of different ways. It was this great, innovative, unconventional policy. Maybe it shouldn't have been from Peter's standpoint. But now, listen to them. They don't talk anything about that. They don't tell us what the big balance sheet now is, what its implications are for conducting monetary policy. Is the fact that the big balance sheet is going to be bigger, does that mean it affects their decision on what IOER is going to be? Or interest rate policy, or the funds fund rate? What's the relationship between these two things? They have not given the markets and the public no clue as to how those two things are related. And now they're talking about the balance sheet completely different from the way they did going into the crisis. So there are just a lot of, to me, unanswered questions that they haven't addressed that are looming out there that are important for lots of things, I think.
So, since Peter is not going to respond to that at all, I will take his minute and add that, of course, there is a little bit of tightening in shrinking the balance sheet. but we don't know how much, and the Fed doesn't know how much. And what Charlie keeps pointing out that is very important is the uncertainty of the interrelationship. If you combine that with Peter's point, both the balance sheet and interest rates matter. We are uncertain about that, and the tendency that I think we all imply the Fed is moving into these days is to try to avoid discussing that uncertainty by focusing on the interest rate policy and trying to present the balance sheet as a technical issue. And the two are related. Just because there is uncertainty, this isn't the reason not to discuss how the Fed should be moving systematically about it. I think this is what we should keep calling on it. So we're going to move. We're going to take a couple more questions. Steve there, and then we have 1 and 2, 3 more questions here.
Charlie, what did you think of the in the back here, Charlie?
Oh, Steve, okay.
I
I heard the voice, I just couldn't find it there.
What did you think of the recent apparent market reaction to the Fed's plans for the balance sheet and the Fed's reaction to it? It seemed like the market got to a place where it kind of woke up one morning and said, oh my God, you're reducing the balance sheet after having the Fed talk about it for many years. Right. And then for Peter, I don't know much about the history of monetary policy, but one of the first things you learn when you get into this world is that they abandoned the M aggregates a long time ago because they didn't work. And I know that's sort of heresy perhaps in this group, but maybe you could explain to me why I ought to be thinking about M aggregates again. Thank you.
Okay, well, let me actually, I'll respond to both of your questions. I mean, my reaction to the bond market reaction to the Fed and the Fed reaction to the bond market at the end of last year is that kind of thing was reminiscent of what happened in the early days of building credibility for inflation fighting after Volcker successfully finished the first round of disinflation and there were periodic inflation scares. So the specifics of what happened, I'll let Charlie comment on, but in the broadest sense to me, it seemed like a symptom of how discretionary policy weakens the Fed's credibility. Going back to your point, or then the second point on M1 and M2, that's an excellent point and it allows me to be clear on this. For the reasons that you alluded to, instability in estimated money demand relationships for broad monetary aggregates, I would not advocate going back to the old days where the Fed announced periodic targets for M1 and M2 and described the success or failure of its policies in reference to hitting or missing those targets. My point would be, though, that if you want a gauge of the stance of monetary policy when the zero lower bound is making the level of interest rates uninformative, perhaps you could bring back into the picture readings on the broad monetary aggregates. So, for example, the fact that despite 3 rounds of quantitative easing never really generated a sustained pickup in money growth. Perhaps that explains why inflation has run below target ever since the financial crisis. So the Fed doesn't have to target M2. It could, however, describe quantitative easing as an effort to not just increase the volume of reserves held by the banking system, but generate growth in broad money that would then feed through to nominal spending and income.
So, I think Peter gave excellent answers. Under your first question in particular, Steve, I would say this is part of the problem Peter alluded to when we talked about credibility. The Fed spent 4 years convincing the markets and the public that the balance sheet size was really important for monetary policy. And now that they want to shrink it, they want to kind of, play that down. They don't want to apply a consistent theory here about, and they haven't told us why it's not important now. So I think that they have, there are these internal inconsistencies that they're not addressing. They may have an answer for it, but they just haven't told us what it is. And I think the Fed started shrinking the balance sheet 1.5 years ago, roughly, or so, something like that, right? And there was no market particular reaction. Then all of a sudden this fall, it sort of, or at least people said that it was alerted itself to the fact that, oh my God, to us, they're tightening. Well, I don't know, I think that's a bit self-serving in some parts of the marketplace and in the Fed. And I think one way to interpret it is that, well, wait a minute, the Fed told us this was important, now we have to react because now they're taking it away. Well, as you know, my view would be, well, it wasn't that important in the first place. And so it's really not that important on the other side for some, but they haven't reconciled that. So Paul Volcker once told me that he learned from Norman Norman, I can never remember which way his name goes, that a central banker should never explain and never apologize. So the Fed doesn't want to be in the position of apologizing for the fact that maybe their story about QE in the first place wasn't quite right, or that their story now about the balance sheet isn't quite right. I don't know which way it goes, but they need to square the box here somehow. And so I think that the reaction, perhaps in the fall, might be interpreted as that well, the markets were just responding how the Fed taught it to respond, because that's what they wanted on the other side. So I think it's possible to square the box, but the Fed has made no effort to do that, and that's part of this credibility problem. Is they want the markets to think one thing one time and another thing something else, and they think they can manipulate that in ways that are easy, and I think it's really quite hard. So I think it's back to credibility and communication in some sense.
And we have two more questions.
Thank you. Based on a sidebar conversation 2 days ago with two Federal Reserve officials and a couple of back-of-the-envelope calculations myself and my colleagues did, this is what I'm led to believe, and I was wondering if you could comment on that. On the currency demand side of the liability side of the balance sheet, the currency is about 1.5 trillion, has been growing at 8% and is expected to grow at 8%. On the reserves deposit sides of the balance sheet, that's currently about 1.75 trillion. After the roll down, it's going to come down to about 1.5 trillion. So that gets us to 3 trillion on the liability side of the balance sheet. And there's a $500 billion deposits of both the US central government and other central governments, again, on the liability side. So after the roll down at about towards the end of the year, we have a steady state of the liability side of the balance sheet of 3.5 trillion. So I was given the forecast that the currency side of that portion is going to keep on growing at 8%, but no guidelines regarding the reserve side. So I was wondering if you could comment on that. And clearly there will be also substitution between the mortgage-backed assets and treasuries. Thank you.
So a couple of reactions. One is the currency is it is what it is. It is growing. That's why I say I've never claimed the balance sheet ought to go back to its old size. That's not the story here. I think the real issue, and frankly, what the governments deposit, there's some endogeneity there that probably Mickey and some others can maybe explain more carefully than I can. But the process of the U.S. government having deposits at the Fed has exploded since the crisis. And they were never as big as they are now. And I think there's some technical reasons why that's happened that have to do with the way we've conducted monetary policy. But let me just put that aside, because that's a bit exogenous too, so I don't want to dwell too much on that. But on the reserve side, what I'm talking about is the volume of excess reserves. That's the number that's driving this. Yes, they're about 1.7, or I think that's at 1.5, 6 or 7 trillion in total reserves. But of that 1.7 trillion, 1.6 trillion is excess reserves. That's the number that's driving this that I think is really, that I'm concerned about. And that's the number that can drive, and if they don't know what that excess reserves is going to be, because they want to be able to adjust it they haven't given us a criteria for how they're going to decide how many excess reserves are they going to tolerate or support or deliver. That's what's driving, from my perspective, that's what's driving the difference, I think, in our points of view. My points of view with the Fed is sort of what they do with that. And if required reserves are only 100 billion,
why have we got 1.6 trillion? All right, and so that's 1.5 trillion difference in the size of the balance sheet that they might get if, instead of 3.5. If they got rid of excess reserves, it would only be 2. That's a big difference. So it's what happens to excess reserves is the issue here, from my perspective.
Yeah, well, I would agree with that. I mean, the main determinant of excess reserves is going to be the opportunity cost of holding excess reserves as measured by the difference between the interest rate paid on reserves and the federal funds rate. So the Fed needs to figure out approximately what level of excess reserves, so-called excess reserves, does it want banks to hold for financial stability reasons, and then determine the steady state interest rate spread based on that consideration. But from that point forward, reserves would become somewhat like currency. The spread would be held, the opportunity costs would be held more or less fixed. And so you would see growth in demand paralleling growth in nominal GDP. For currency, there's an add-on because of foreign demand. But then the monetary policy problem from a monetarist perspective is you figure out what the target for nominal GDP is, you know the growth rate and the demand for base money, and you conduct policy in a way that generates growth in base money supply to hit the target for nominal GDP growth.
And by the way, for much of this last 10 years, periodically it switches, but for the most part, interest on reserves pays more money than you can earn in the Fed funds market. So what do you think banks' preferences are going to be for either lending Fed funds or borrowing Fed funds versus interest on reserves? So that's part of the technical problems that have created a lot of jerry-rigging around this system.
Right now, that gap is 0.
Right now it is, but it hasn't been for most of the last
You
9
have
years.
2 minutes for one brief question and a very, very, very brief answer.
All right, so both of you have circled around a question about the magnitude of the disconnect between what the Fed's looking at and the financial markets. Charlie, your last point on IOER was an example when you look at estimates of how much of that is actually global flow of funds coming in from other countries. And at the ASSA conference, the magnitude of this difference was apparent because you had the economists in one building looking at one number, and across the street were the financial people comped on a whole bunch of things, looking at things that the FOMC was not completely looking at. Even Bernanke and Williams were on this conversation. So you're circling around it. Could you sort of punch it to give that closing answer Anastasios is looking for?
Well, I would have a two-part very quick answer. I would first say that this is a reason why the Fed needs to adopt a specific rule expressed as a contingency plan, because here what we're talking about is appropriate setting for monetary policy instruments based on what you believe is happening in the economy. So that's uncertain, and it may change even on short notice, and you want to communicate to what the Fed would really like to communicate is if, in fact, real GDP is going to be 1.8% and inflation 1.5%, then no more interest rate increases. But if 3.2% real GDP, 2.2% core inflation, then yeah, they're going to need to move up by more than 100 basis points. But my second part of the question is, this is Mickey's focus entirely, the idea of bracketing these forecasts with reasonable estimates of uncertainty. And so we'll hear more about that next.
Yeah, so I'll just echo 2 things. One is I tried to get the FOMC to put brackets around its forecast, uncertainty brackets. Hasn't done that yet, but it would be very helpful about where the uncertainty is. The second point I want to make is that, and I made this indirectly in my remarks, is that IOER is not a market rate. It's a rate set by the FOMC, by the Board of Governors. So the question is, how do you choose that number? You can't take market, there's no market influence on that number. So you have to reach out somewhere to determine how you think that right number is. Now, under many kind of rule-based policies, you look at markets and signals. What's the relationship between the setting of the IOER and what's going on in the marketplace? They haven't told us anything about that.
there may be ways to answer that, and I could probably come up with some of my own, but it's this notion of administered rates versus market rates is complicating that story that they want to tell about setting interest rates.
And this is a very good way to have a transition to panel 2, Fed communications and suggestions for improvement that will probably continue answering these questions. Thank you.